Hello fellow boomers, and welcome back to our channel. We're witnessing something unprecedented in the history of technology. Companies are pouring hundreds of billions of dollars into artificial intelligence infrastructure at a pace that makes the dot-com boom look modest. Tech giants are making deals worth more than entire countries' GDP. GPUs have become more valuable than gold per pound. But here's the trillion-dollar question. Is this the foundation of a transformative new economy, or are we watching the inflation of history's most sophisticated financial bubble? The truth, as always, lies somewhere in the fascinating middle. Today, we're diving deep into the complex web of investments, circular deals, and financial engineering that's reshaping the AI landscape. We'll explore both sides of every coin because understanding this moment requires looking beyond the hype and the doomsaying to see what's really happening. But before we can answer whether this is revolution or bubble, we need to follow the money. And when you start tracing where billions of dollars are actually flowing in the AI economy, you'll discover something fascinating and possibly disturbing. The money isn't moving in straight lines. It's moving in circles. Stay with us, because what we are going to show you will change how you see every AI headline from here on out. Before we dive in, we want to hear from you. Where do you stand on AI right now? Are you excited, skeptical, or just trying to figure out what's real? Drop a comment on the comment section below with your take. This is a conversation, not a lecture, and your perspective matters. And if you're finding this approach to understanding AI refreshing, go ahead and hit that like button. It tells the algorithm that nuanced analysis matters, and it helps others discover content that treats them like intelligent adults. If you haven't subscribed yet, now's a great time. We're building a community that values depth over hype. And if you know someone who's trying to make sense of the AI economy, whether they're an investor, entrepreneur, or just curious, share this video with them. All right, let's get into it. Financial engineering has become the invisible architect of the AI economy. At its core, financial engineering uses sophisticated techniques to optimize operations, manage risks, and enhance decision-making. When applied to AI, it creates what proponents call a circular economy, a self-reinforcing ecosystem where investments flow between companies, driving innovation and growth. Critics argue this circular economy creates a dangerous feedback loop. When Company A invests in Company B, which then uses that money to buy products from Company A, it becomes difficult to distinguish between genuine market demand and artificially inflated revenue. This isn't just theoretical. We've seen this pattern before. During the dot-com bubble, telecom companies lent billions to startups that used the money to buy their equipment. When the bubble burst, those companies collapsed under mountains of bad debt. On the other hand, supporters point out that strategic partnerships and cross-investments have always been part of technology evolution. When Microsoft invested in Apple in 1997, cynics called it desperation. It turned out to be visionary. These circular relationships can actually accelerate innovation by aligning incentives and reducing friction. Companies that are invested in each other's success are more likely to collaborate effectively, share technology, and push boundaries together. The real question isn't whether circular investments exist. They clearly do, but whether they're built on solid ground or speculation. Let's talk about the deal that has everyone talking. In September 2025, Nvidia announced it would invest up to $100 billion in OpenAI to build at least 10 gigawatts of data center capacity. To put that in perspective, that's enough power to run 8 million homes. It's also more than Nvidia's entire fiscal 2024 revenue. Here's where it gets interesting. OpenAI receives $100 billion from Nvidia, but that money is largely spent buying GPUs and infrastructure from Nvidia. One analyst colorfully described it as, Nvidia invests $100 billion in OpenAI, which then OpenAI turns back and gives it back to Nvidia. Add to this that Nvidia has also invested billions in CoreWeave, which supplies data center capacity to OpenAI and is itself an Nvidia customer. It's a web of interconnected investments where money seems to flow in a circle. Critics compare this to past technology bubbles. During the dot-com crash, Cisco and Nortel extended financing that exceeded 10% of their annual revenues to customers. When those customers failed, the equipment makers held worthless debt and massive overcapacity. But let's consider the alternative view. This isn't just vendor financing, it's a staged strategic partnership. The $100 billion isn't handed over at once. It's deployed progressively as each gigawatt of infrastructure is built. Nvidia becomes a co-builder of the infrastructure, not just a supplier. This aligns incentives in a way that actually reduces risk. Moreover, OpenAI has over 700 million weekly active users and generates real revenue, projected at $13 billion for 2025. Companies from enterprise giants to small businesses are paying for ChatGPT and API access. Microsoft, Oracle, SoftBank, and others are also investing in this infrastructure, suggesting multiple sophisticated investors see genuine value. Jensen Huang, Nvidia's CEO, stated that this partnership represents a decade of collaboration, finally scaling to meet unprecedented demand. Sam Altman emphasized that everything starts with compute, and that this infrastructure will enable new AI breakthroughs. These aren't empty promises. They're backed by measurable adoption metrics and revenue growth. Special Purpose Vehicles, or SPVs, have become a hot topic in AI financing. These are separate legal entities created for specific purposes, and they're everywhere in the AI infrastructure build-out. SPVs can be powerful tools for hiding debt and managing financial appearances. By transferring assets or liabilities to an SPV, companies can keep obligations off their main balance sheets, making their financial health appear better than it actually is. We've seen this movie before. Remember Enron? The energy company created over 3,000 SPVs to hide debt and bad deals. When the house of cards collapsed, it took down entire pension funds with it. In the AI sector, companies are using SPVs to shift massive amounts of infrastructure spending off their books. This practice, combined with accounting techniques that depress reported spending, can inflate profits and valuations. It raises a red flag. If the AI build-out is as promising as claimed, why the need for financial engineering? However, dismissing all SPVs as suspicious would be throwing the baby out with the bathwater. SPVs have been standard practice in infrastructure financing for decades. They serve several legitimate purposes. First, risk isolation. When building a $50 billion data center, it makes sense to isolate the financial risk from the parent company's core operations. If the project faces challenges, it doesn't sink the entire company. Second, enabling complex partnerships. Large infrastructure projects often involve multiple investors, governments, and stakeholders. SPVs provide a clear legal structure for managing these relationships, defining rights, responsibilities, and returns. Third, project-specific financing. Lenders often prefer lending to SPVs because they can secure assets directly and monitor cash flows more clearly. This can actually result in better terms and lower interest rates. The Indian government, for example, routinely uses SPVs for major infrastructure projects like smart cities and highway development. These aren't schemes. They're transparent structures that make large projects manageable. The key distinction is between SPVs used for legitimate project structuring and those used to obscure financial reality. One is sound engineering, the other is Enron. The demand for GPUs has exploded. But is it real, or are we looking at an artificial bubble driven by speculation? The numbers are indeed concerning, and it is possible that there are bubble warning signs in them. Tech companies are projected to spend $400 billion on AI infrastructure in 2025 alone. That's more than the inflation-adjusted cost of the Apollo program. One analysis found that AI-related spending accounted for half of US GDP growth in the first half of 2025. That's not normal, that's unprecedented concentration. There's also a troubling disconnect between AI productivity and profitability. While AI technologies have demonstrated impressive capabilities, many companies struggle to translate these advancements into actual returns. A recent MIT study found that 95% of companies are getting no measurable value from generative AI. If most companies aren't seeing returns, why is demand still soaring? GPU rental prices have been falling despite production constraints, dropping from $320 per hour for the B200 to $280 in just months. This could signal weakening demand beneath the surface hype. But no one can ignore the fact that there's compelling evidence on the other side too. Britton Winterrose, Microsoft's lead for technical business development, posted that his whole job is begging for GPUs, and has been since 2020. He dismissed AI bubble concerns as deluded, pointing to chronic shortages. If this were artificial demand, why would startups be desperately competing for access? TSMC chairman c.c.wei reported that the number of tokens required for AI computation is almost doubling every 3 months. This isn't marketing speak. It's the CEO of the world's largest chip manufacturer citing actual production data. BlackRock CEO Larry Fink argues that the massive capital flowing into AI isn't a bubble, but necessary investment for technological leadership. Investing in AI doesn't just mean investing in GPUs and chips, he noted. It means investing in power grids, cooling systems, and entire supply chains. Consider the applications. AI is being integrated into medical diagnostics, drug discovery, autonomous vehicles, climate modeling, cybersecurity, creative tools, coding assistance, customer service, manufacturing, and countless other areas. OpenAI alone serves 700 million weekly users. That's not hype, that's adoption at massive scale. The reality might be that both things are true. There's genuine transformative demand and speculative excess. The question is, which force is stronger? The AI economy isn't just about money, it's about geography, power, and geopolitics. The United States has implemented a tiered export system for AI chips, with different restrictions for different countries. This creates a complex web where companies must navigate national security concerns, regulatory environments, and talent distribution. Export controls and geographic barriers fragment the market and create inefficiencies. Companies like Nvidia must develop different chip versions for different markets, reducing economies of scale. Some argue these restrictions hamper innovation and create opportunities for competitors in less regulated jurisdictions. Others counter that AI represents a critical national interest, like aerospace or nuclear technology. The most advanced chips are genuine strategic assets. Countries are right to be cautious about technology that could shift military, economic, and social power. The concentration of AI talent in specific regions, Silicon Valley, London, Singapore, Tel Aviv, means that geographic strategy genuinely matters for national competitiveness. This isn't just policy wonkery. Where data centers get built, which countries develop talent, and who controls compute capacity will shape the 21st century as profoundly as oil reserves shaped the 20th. So where does this leave us? Are we witnessing the birth of a transformative technology that will reshape civilization, or are we watching a financial bubble inflate in real time? The honest answer is probably both. History teaches us that major technological transformations, railroads, electrification, the internet, often go through phases. First comes genuine innovation, then comes speculative excess as investors race to capture the opportunity. Markets overshoot, valuations disconnect from fundamentals, and eventually there's a correction. But after the bubble pops, the technology doesn't disappear. It integrates into the fabric of society and continues transforming the world, just more slowly and pragmatically than the hype predicted. We're likely in that middle phase right now with AI. The technology is real, the applications are real, the 700 million people using AI tools each week are real. But some of the valuations, circular financing arrangements, and projected returns probably aren't sustainable at current levels. The risks are significant. Companies are deploying hundreds of billions based on uncertain returns. Circular investments between vendors and customers create the illusion of demand. SPVs can hide the true cost and risk of projects. If the anticipated productivity gains don't materialize, or if alternative technologies prove more efficient, we could see a serious correction. But the opportunity is equally significant. AI is already proving its value in drug discovery, climate science, education, accessibility, and countless other domains. The infrastructure being built today will serve computing needs for decades. The companies making smart investments now could become the foundations of a new technological era. The key insights for anyone trying to navigate this landscape. First, demand diversification matters. Companies and investors overexposed to a narrow set of AI applications or dependencies are most at risk. Those building across multiple use cases and revenue streams are more resilient. Second, fundamentals still matter. No amount of financial engineering changes the basic question: can this technology deliver value that customers will pay for? Companies that can answer yes with evidence will survive any correction. Third, the correction, if and when it comes, won't be the end of AI. Just as the dot-com crash didn't end the internet, an AI correction would likely accelerate the transition from speculation to sustainable business models. Fourth, this moment requires both excitement and skepticism. We should be excited about AI's potential to solve hard problems and expand human capabilities. We should also be skeptical of valuations based on projections rather than results, and of financial structures that seem designed to obscure rather than illuminate. The AI economy is being built right now through a complex interplay of genuine innovation, strategic investment, circular financing, geographic competition, and yes, some degree of speculative excess. Understanding this complexity, resisting both blind optimism and reflexive skepticism, is essential for anyone who wants to participate intelligently in this transformation. Whether we're heading for a soft landing or a hard correction, one thing is certain: the next few years will reveal which of today's massive bets were visionary investments and which were expensive mistakes. The companies, investors, and countries that have done their homework, built on solid foundations, and prepared for multiple scenarios will be best positioned to thrive in whatever comes next. The AI revolution is real. The AI bubble might be too. And that's not a contradiction. It's just how transformational technology always works. The question isn't whether to participate, but how to do so with eyes wide open to both the extraordinary opportunities and the very real risks. What's your take on the AI economy? Do you think we're witnessing a genuine technological revolution, or are we in bubble territory? Have you seen AI deliver real value in your work or life, or does it feel more like hype? I'd love to hear your perspective in the comments below. Whether you're a skeptic, a believer, or somewhere in between, your insights add to this important conversation. If you found this deep dive valuable, please hit that like button. It helps more people discover balanced, thoughtful analysis in a world of hot takes and clickbait. And if you haven't subscribed yet, consider joining our community. We're committed to exploring complex topics like this with intellectual honesty, looking at multiple perspectives, and cutting through the noise to understand what's really happening in technology and finance. Share this video with anyone who's curious about AI, investing in tech, or just trying to make sense of the headlines. These are the conversations we need to be having as this technology shapes our future. Thanks for watching, and I'll see you in the next one.